Well, howdy there, folks. Welcome back to the channel. Today, I want to talk about a potential game changer for dividend investing. Now, my first dividend video that I did on my dividend portfolio reveal was a hit, so I figured I would continue with a discussion on this. So this ETF, this is an actual ETF that pays a tremendous dividend. It pays about 11%, actually more, and I'll show you. It's called QYLD, and it's a covered call ETF. So if you like options trading, you like dividend investing, and you like ETFs and index funds, this is like a perfect nexus of all three in one. So let's go over this fund real quick. This is the Global Nasdaq 100 Covered Call ETF. So those of you that invest in QQQ, which is the Nasdaq 100 ETF, this actually could be better and more stable at the same time. And let's go into exactly why. So first, what is a covered call ETF? So you've probably heard of a covered call in options trading. So covered calls, let me just read this to you here from Investopedia. Covered calls are an excellent form of insurance against potential trouble in the markets, which, what are we seeing right now? Lots of drops in the market. When an investor with a long position in a particular asset sells a call option for that asset, generating profit in the process, it is considered a covered call. A key to the covered call approach is that the call option buyer is obligated to pay a premium to buy it. That means smaller losses when the asset declines in value, but the seller can still benefit if it goes up in price, provided the calls were out of the money. So don't worry about that. That's kind of the behind the scenes of options trading when it comes to covered calls. This fund actually does this for you. So when you buy into it, and it's got an expense ratio of about 0.60, which is a little high, but you'll see the benefits you get for this. So here's some key takeaways on this. According to a study commissioned by the CBOE, a strategy of buying the S&P 500 and selling at the money covered calls slightly outperformed the S&P 500, partly due to the increase in returns when market volatility is high, which it is right now, of course. A covered call approach is usually considerably less volatile than the market itself. A covered call ETF will also perform quite differently than the S&P 500 during particular years, like this one. Covered call ETFs make a relatively complicated and fairly profitable options market strategy easily accessible to average investors. So I first learned of this about a month ago, and I'm actually going to show you. I got into it in my Roth IRA because I saw the dividend that it offers, which is tremendous. So here's the dividend yield right here, according to Yahoo Finance, 11.8%. But if we go and look at the historical data, you're going to see that it actually pays out various distributions that aren't exactly part of the monthly dividend. And that's another interesting thing. This dividend is monthly. So whereas a lot of dividends are quarterly, this dividend pays out monthly. So every month you get dividend income. And I see a lot of videos on with a flashy thumbnail saying, ooh, make $1,000 a month in dividends. And usually you think to do that with the average like 4 or 5% dividend and most dividend paying stocks, you have to have like 300,000 or 400,000. Well, I'm going to show you in this one, you only have to have 100,000 invested in this to actually make more than $1,000 a month. So let's look at Yahoo Finance historical prices. I'm going to change this to dividends only. Frequency, monthly, apply. And let's look at the last year. So you can see since last March, it pays out a 22.4-cent dividend, which fluctuates every month, but it's around the same. In June, it was 0.194. August, it was 0.188, 0.19 in September. And then look in December at the end of the year, it paid out like a end of the year special dividend. So you can see here, this actually is higher than just the standard, let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. No, there is 12 payments here, but this payment is actually higher. So I actually took this and put it into Excel so that you don't have to, one of the many benefits of watching this channel. So I took these numbers and applied it, and I bought 210 shares of this in my Roth IRA. So this is what this will pay me, $42 a month. Well, I actually went back, so this is going back in reverse. So that December one for 49.9 cents, that would pay $104 on the 210 shares. So if you look at the sum here of all of these payments, and I just multiplied this by the 210 shares, that you can see the formula here, So it would pay $586.74, which is actually a 13.97% dividend payout. Now, what you'll see a lot with dividend stocks, when the price drops, the dividend yield actually goes up. Why is that? Because the dividend is a fixed amount, and that's like the numerator. And then the stock price is a variable amount because it changes. So that's like the denominator. So very easily, like take AT&T, for example, if they pay out a $2.08 dividend every quarter, and the stock price is $35 a share, then this dividend yield is going to be 2.08 divided by 35, 6%. But as we see, AT&T's been performing abysmally. So like say AT&T's trading at $25 a share, suddenly that dividend payout is 8.32%. And then suddenly that will show up on a lot more people's radar that, wow, this is 8% dividend. So suddenly it's like the dividend is going up, but this is where critical thinking comes into play, because dividends increasing isn't always necessarily a good thing. That's why you have to really be careful and watch videos like this to know which ones are good and which ones are bad, right? So this one I think is pretty stable. So if you look here, so 13.97% payout, and that's the sum of these divided by this. Actually, if I scroll down here, yeah, divided by, let me see here. Yeah, so 13.97, and then times 100,000. If you put 100,000 into this, you would have a almost $14,000 annual payout, which is $1,100 a month. And then over the past 8 years in QYLD, this would have paid, if you had 100,000 in it, you would have made 111,760 just in the past 8 years. So this is really phenomenal. So let's go back here. I'm actually going to show you some really behind the scenes stuff here. This is my, this is in E-Trade. This is my dividend estimator. And actually investing in this has increased this significantly just in the Roth. This is just the Roth IRA. So I sorted it. There's AT&T, which is my top dividend paying stock, IBM. So now my third one in the Roth IRA is QYLD. So you see here every month, you see for a $42 payout. And why is that 49-cent payout not here? Because that's an annual one at the end of December, it seems. Those don't show up. Those are more like long-term capital distribution. So those don't show up here. So the estimator actually underestimates what the total dividend payout will be. So with that being said, let's go and look at the performance of this, because it's dropped a bit. So it's probably at a decent buying point. It's actually dropped from where I bought in a couple of weeks ago. So if we look at it year to date, it started out at $22.29, and it's dropped a few dollars. It dropped to $19.89, January 27th, came back up. It was over $20 mid-February, then it dropped again. And then, yeah, it's dropped. It came back a little bit yesterday and today. And so let's look at what it's done. This was started, the fund inception was December 11th, 2013. So it's been going for over 8 years. And the price has been pretty much, well, it's down from where it started, but you see the huge dividend payout that it pays out. And it achieves its objective, like I mentioned here, with the covered call strategy. So by buying the index, which is the Nasdaq 100, and selling at the money covered calls, it's able to achieve the investment objective and provide this dividend. So funds like this are really a game changer for the dividend investment strategy. But you're not going to have like huge appreciation in value because it's paying out so much in a dividend. And really, I forget who said this. I don't know if it was Warren Buffett or who it was, but some famous investor said, most of your returns or your more stable returns in a stock or an index or any kind of investment are going to come from like a dividend payout, not from the actual appreciation in the stock value. Because if you think about it, like your total return is your dividend return plus whatever the fund appreciates to. So the best way to achieve a return like upfront immediately is to have the dividend coming in every month. And I think this being a monthly dividend instead of quarterly is really awesome. But you'll see here, the fund it hasn't really dropped that much. It's been pretty stable over time. In 2018, it was still at 25. And then it was like 23.51, dropped here at the onset of the Rona. By the way, we're not hearing much about the Rona in the media anymore. It seems like since the Russia thing, like it's done. All I can say is finally, right? So it came back up here, dropped a bit. And then, I mean, you see there's not a lot of fluctuation in it. And then we can look at the holdings here. It's basically the NASDAQ 100. You can look at all these different fundamentals on it. It's got a 4-star rating out of 5 on the Morningstar scale. Here's a fund summary. The fund will invest at least 80% of its total assets in the securities of the underlying index. The CBOE NASDAQ 100 Buy Right Index is a benchmark index that measures the performance of a theoretical portfolio that holds a portfolio of the stocks included in the NASDAQ 100 and writes a succession of 1 month at the money NASDAQ 100 index covered call options. It is non-diversified. Net assets, 5.9 billion. Let's see what this tab shows. Oh, it's actually, how ironic is that? A covered call ETF has its own options too. So you can actually buy call options on it or sell them or whatever. Profile, here's the Morningstar rating here. Let's see what this says. I'm not going to read all that, just peruse it here. Chart, we looked at the chart already. I don't spend a lot of time focusing on technical analysis, but I mean, you could pull up a candlestick chart here if you wanted to. I haven't talked about candlestick charts in a while. Probably because the way this year has gone. It's not really doesn't seem like much of a technical analysis kind of focused year. Anyway, let's go back to Investopedia, find some more stuff here. Oh, potential for higher returns. So according to a study commissioned by the CBOE, a strategy of buying the S&P 500 and selling at the money covered calls slightly outperformed the S&P. We know that. The study showed an 830% return to the at the money covered call strategy between 1986 and 2011. During the same period, the S&P went up 807. So it did outperform. The key to the strategy's success is that the value of covered calls on the S&P 500 goes up when volatility, as measured by the VIX, goes up. The VIX is also known as the fear index because it tends to rise when fear of losses is higher, which we're seeing a lot this year. When one considers what a call option does, it's only natural that the value would go up when anxiety is high. Right, because a big component of the price, like if you were to break it down into components, a big component is intrinsic value, or implied volatility, I'm sorry. I got the IVs mixed up. A call option allows the buyer to get all the gains of a security with none of the downside risk during a specified time. So you see it's kind of hedged. And this is why I think this is so great. Since perceived risk and real rewards tend to be correlated, the call option buyer's low risk results in fairly low returns in the long run. The call option seller who takes a high risk of loss with limited potential for gain in any given month turns out to do much better in the long run. So that's the gist of that. That's really what I wanted to discuss today. And really, you can focus on this here as a takeaway. So yeah, that's really pretty good. So hopefully that's definitely, I think it's a game changer for dividend investing. If you like that, please remember to like, comment, and subscribe. And thanks so much for watching. Take care. Oh, and I am going to have that video about gas prices out very soon. I'm working on that. That required a little bit more effort than this one, so I figured I'd get this one out first. So again, thanks for tuning in. Take care.